Good evening. This is Tom Alexander. It is Wednesday, March 1st. It is about 5:24 p.m. Eastern Time in beautiful Charleston, South Carolina. I'm doing this on Wednesday evening because I'm getting ready to go out of town for a couple of days, and things are setting up in a real interesting manner, and I think it merits immediate discussion. So let's take a look at the charts. By the way, this is an addendum to a written report that I send out. This is the video addendum. If you're not receiving that report, shoot me an email to tom@alexandertrading.com if you would like to receive that report, and I will put you on the list. It's free. And also, if you find value in the video, if you will like it, make comments, subscribe, all of those things are very helpful trying to grow this channel. And that's the way to do it. So, okay, let's take a look at some charts. Hold on a minute. I'm going to close my door because my dog has decided to become involved. Okay. Let's start with the S&P. Now, this is the SPX, the cash charts. I think the cash charts give the more meaningful levels. And I put in last weekend's report that it would be bullish if all four of the U.S. Primary trading indices were to close above last Thursday's high. That's increasingly less likely than some sort of downside resolution, but that is still what it would take to trigger a bullish short to intermediate term assumption on the stock indices. Now, the S&P, the SPX closed right at the edge of its abyss. It closed right on top of this 200-day moving average and right on top of the low of the 24th. Below this level, you're looking almost immediately, probably down around 3,900, below about 3,874. Then you're looking at the December lows. Okay. Let's look at, I want to come back to the Russell. I'm going to do the Russell last. Let's look at the NDX. All right, the NDX is in a similar position below the low of the 24th, which I think was last Friday. There's really not much. You're guessing where this thing stops. I will be, if we start to break down, I'll be keying off of the SPX for the NDX levels. They will not, they'll stop pretty coincident in time, at least, if not price. But to the downside, below Friday's low, this is the next potential support level that's identifiable by any objective means, specifically auction market principles, where previous trade has occurred between buyers and sellers. I do not use magic numbers. Okay, the Dow continues to attempt to fall into the abyss. If it does fall into the abyss, the next identifiable potential support doesn't begin to around 30,843. That would represent about a 5% plus move lower from today. Okay, now let's look at the Russell. The Russell is really interesting. We have an extraordinarily narrow range in the Russell. And I want you to notice the closes in the Russell since the close of the 21st. And the closes have been, we have one little outlier. This on the 23rd, we closed up here. But since then, all the closes have been clustered in this range. That's remarkably tight. So what this is a balance area. Now, it's not as clear from this particular perspective. So let's go to, and this is where the market profile chart comes in very handy in helping to identify market condition. That is what it was intended to do. It's not a magic trading system. You don't magically trade market profile. It is a graphing format that helps us to identify auction market condition. At times it's better than a bar chart. At times it's not as good as a bar chart. It is a means to an end, not an end in itself. Okay, so let's look at it. What is it telling us? Well, here it is. This is the auction in the Russell beginning on February 21st. And this is all the trade that occurred up to today. This is today's trade. The black is today's session. The blue and the green is Globex session. You can see we closed right at the high volume node. So in general, when you have a mature profile structure, which this is, the guideline is you want to be long above the high volume node, you want to be short below the high volume node. Now, obviously, it's not quite that simple, but that's the general guideline. You don't want to be caught short or long if you're above the high volume node, and you don't want to be caught long for long if you're below the high volume node. So today's really cash session range, you want to be long above it, you want to be short below it. Now, if this looks familiar, let me show you. We had a very similar pattern back in December in a different contract, in another contract, in the ES. And this is the ES back in December. And this was, now this is a 240-minute, each unit is a 240-minute profile, meaning each slot, each letter slot is 240 minutes. I've done this so I could get the data on the screen. But I'm going to combine all this into the auction that it was and show you. And this, what I'm showing you here, it's a wonderful display of the fractal nature and the recurring nature of the auction market process. It's a three-step process. At times it's clearer than others. It's not magic, but it's consistent, it's objective, and it exists in all contracts and all degrees of time all the time. And when it is clear, it can provide a very good roadmap to market condition. If we can understand market condition, then we can narrow down our trade ideas in a probabilistic fashion and identify trades that have a greater reward to risk, a greater reward than risk of the trade. So this is the structure that occurred. This was the dramatic breakout. Now, again, the black is day session, the color, the green, the blue and green is Globex. We had the giant gap up as we traded back through this high volume node, and then we went higher and higher up into this top. So that's where we are in the Russell. Now, something else we want to take a look at here. Let's look at the technical information. What is it telling us? And quite frankly, it's not telling us a whole lot here. There are a lot of if, and, or buts here. This is one of these times where, and we always want to default to price action. Price action has to confirm information from any other source. Price action is what we trade. Price action determines whether or not we make money or lose money. It's not about any indicator or outside information, whether it's macro, fundamental, or some sort of super secret technical sauce. Now, what this is, for those of you that may not know, this is data derived from NYSE advancing and declining issues. NYSE data, that's actual auction market data, right? The red line is a 10-day moving average of advancing issues. The green is a 5-day moving average of advancing issues. And the blue is the net, its breadth. We've had one negative 2,000 down day, with the exception of December, what, 5th? 6th, yeah, 5th. Since the waterfall decline that ended abruptly in October. If we're in a bear trend, do not be surprised to see another negative 2,000 breadth reading very soon. Now, the 5-day and the 10-day moving average, they're in a position where they can go either way. Who knows? But the price action is going to determine this. If we have some wide range down days, if we get down to these lower levels of support, it's almost, because nothing is certain in the market, it's almost a certainty we'll see one or more additional negative 2,000 breadth days, and that would put the 5-day and the 10-day moving averages of advancing issues at downside extremes, and that would be very interesting. Okay, guys, enjoy the rest of your week. Enjoy the rest of your weekend. I will speak with you again soon. Take care.